Hey everyone, it's Brandon from the Young Investors Podcast. Myself and Hamish are excited to bring you your weekly rundown of the latest business and investing news from around the world. A quick reminder before we get started that any advice provided by myself is general and does not consider your financial situation, needs, or objectives, so consider whether it's right for you. Brandon Kolk is authorised to provide general financial product advice in Australia and is authorised representative 1305795 of Guideway Financial Services Proprietary Limited, AFSL 420367. Please see the description box for my financial services guide. Past performance is not a reliable indicator of future investment returns, but with that said, let's get into another episode of the Young Investors Podcast. All right, welcome back, everybody. Welcome back to the Young Investors Podcast. We are once again in Melbourne, live in studio, except Hamish, I've got you around this side of the table.
Yeah, wait, what's going on? Wait, am I on the wrong side here? Like, what's going on here?
We're going to do the podcast like this today.
Yeah, we're
very
just
awkwardly.
like this. Yeah.
No, the reason we're both on this side of the table is because we've got someone on the other side of the table, and that person is Morgan Owen from Penny Finance. So, yeah, thank you very much for taking the time, Morgan. It's great to have you on, and appreciate it.
Thanks for having me, guys.
We're going to talk all things property because we were just saying before off air, me and Hamish, we're the stock market guys, but we don't know all that much about property. Whereas Morgan, you know a lot about property. So match made in heaven.
Yeah, exactly. And I'm the kind of opposite of that. So that's great.
Yeah, perfect. Perfect. So Morgan, I'm not sure our audience would know who you are. So you're the founder of Penny Finance. What is Penny Finance? What do you do? How did this all come to be?
Yeah, well, that's a long question. But Penny came to be.
We've got 1 hour.
And we really have to be out. That guy was like, we got to be out of here. No, look, Penny I've had for 4 years now. So started in 2020, COVID, all the fun times from my 1-bedroom apartment. Now we have our office in Camberwell. There's 8 of us and we're growing rapidly. We're constantly looking for new brokers to deal with the amount of lead flow that we have. So yeah, look, things are going really well. We help go-getters ultimately. We help people who want more, want to do better, aren't interested in sort of just having the one property and paying it down. They want to go after the big things. They want to have a property portfolio.
Right. Yeah. Okay. So you're a mortgage broker, your team are mortgage brokers. So you help people take on mortgages and get into homes or make investments.
Yeah, correct. But we do all types of finance. So mortgage brokers may just do residential finance. They may just do owner occupied. They may help self-employed people. That there's so many different types of mortgage brokers out there. We actually do all types of finance. So residential, commercial, development, and also asset finance as well.
Right.
And how did you get into Penny Finance? Did you work in finance previously? Have you always been in finance or how's that work?
Definitely haven't always been in finance. I was actually in fitness before I was in finance.
Oh, right.
Yes.
There you go.
Yes. So my career started, in your early 20s out of uni. I actually thought I was going to be a dietitian of all things. So finance was not on the radar. But I think as you start working and you start building your mentors and your people that are around you, I was really fortunate to have a couple of people that just kind of saw something in me, I think, and pushed me in the right direction, shall we say, pushed me into doing my MBA, pushed me into finance. I was pretty young when I bought my first property. I was always really interested in it. So it was a natural thing to do. But definitely no finance background, no banking background. That is very common in mortgage broking though. But yes, prior to Penny, I had worked for other people. Prior to that, I'm building my knowledge. I didn't just rock out of the gym and into finance and thought I knew everything. No, that didn't happen.
Well, and now you've built a team and you've got a successful business, so you must know what you're talking about, which is great because we don't. And that's what we've got a couple of topics, I guess, we want to cover in this podcast. And the first one that I wanted to talk to you about is getting your perspective on this housing unaffordability crisis. Most of our viewership for the Young Investors Podcast is Australian, so we can definitely talk obviously about the Australian housing unaffordability crisis. But
great, because that's the only market I know.
But all I was going to say on that is that I think while this is happening in Australia, it's applicable to quite a few real estate markets around the world. So I'm wondering from your perspective, like what do people mean when they talk about the housing unaffordability crisis? Can you kind of explain what this crisis is that we keep hearing about on the news?
Yeah, well, let's just start with that because that's where we're hearing it, right? Is in the media. And, like how much of what's in the media is just fear mongering. Like fear is what sells. So the first thing is I think that the media is blowing this whole thing up. Now, I'm not sitting here saying that it's easy. It's absolutely not. But in every generation would have talked about at some point in time how hard things were. Things are hard. Things are always hard. And at the moment, interest rates putting a lot of pressure on people. House prices, of course, they're ridiculously expensive. Rents have skyrocketed as well. And there's also a supply issue. So like when you sort of boil all those things up together, yeah, it's hard. But I also think that, and I often have to do this with clients, where you kind of level out people's expectations. So, we're sitting here in Paran, right? Which is a really nice suburb of Melbourne. You've got Richmond, you've got Toorak around you, skip the other way, you're in blue chip Melbourne. So it just might be that you can't afford that single fronted Victorian in Paran for a 1.5 million as your first house. Maybe not. Maybe that's unaffordable, right?
What?
I know, crazy. So maybe we have to simmer those expectations of what the first property could look like.
Right. Okay. So in your view, this housing unaffordability crisis is not specifically one particular root cause, but it's a combination of things.
Oh, yeah, totally.
Okay.
Yeah.
And as you said, we've got high property prices, high interest rates, rent going up, and demand shortage. What do you think of the demand shortage? Because this is what
supply shortage.
Sorry, yes.
Yeah.
We certainly don't have a demand shortage.
I don't know why I said demand shortage. That's one thing that we definitely do not have. I find it interesting because I think in places like America, a lot of the new houses built are done kind of by the government, whereas in Australia, it's all private, it's developers. So is there an easy solution to that? Because it sounds like, with interest rates higher now, if it's not going to be a profitable development, then they won't do it. I think I can't remember exactly, you'd know better than me, that there was a lot of housing approvals, but when interest rates went up, the housing starts dropped.
Yeah.
So is there an easy fix to this? Or
Look, I think if there was an easy fix, it would have been done. I think the governments would have sorted it out. I think developers would have sorted it out. No, I don't think that there's an easy fix. As someone who does development finance, I can assure you it is hard. It is tough out there right now to get developments off the ground. And it's for similar reasons. Land prices are really high. Valuations are coming in short for the end product. You've got really high cost of funds, super, super high cost of funds. And then you've got the major lenders where the finance costs are decent. But, the amount of restraints that they put on the clients, they've got to put 50% equity into the property. They've got to pre-sell, 50% to 100% of the project. It's just like unrealistic expectations on these projects too. So developers out there right now who are getting it done, and we definitely have developers that are getting it done right now. If they're getting through at this point in time, they're going to be just fine.
Yeah, like one thing I hear, I've certainly heard this in the media is, and I'm sure a lot of people are concerned about this, is whether there's a point at which prices are just too high and that you should stay out of the market. Is that something that you can, share your insights on?
That's an interesting one. Can you actually, and this is a question for you guys. Sorry, I'll throw it back to you for a second. Can you actually think of a time in the future where people are not going to want a house to live in?
No, I can't see it.
It's just not, I just can't see it. I really can't. So no, would be my short answer to that. But also there's so many different markets. So if we go back to my little, point before about Paran, you go further and further out, things do start to become more cost effective, right? It's just going to depend on your lifestyle, what it is that you're after. And then the next thing, which I think, there's some questions a bit later we might get to, but there's rent vesting as an option. You don't have to live in the property that you own.
Right, okay.
So it seems like the vibe is that this crisis is probably, if we call it a crisis, but it's a problem that is not going away anytime soon for a multitude of factors that we probably can't control
That's
or
exactly
influence.
Right.
So I guess maybe we should turn more to how do we even get started, because I think that's part of the crisis and why this is blowing up to be such an issue is you've got young people in Australia that are looking to get into the property market. They're not looking to make millions or anything like that. They're just looking for somewhere to live. They're just looking to, just slot in somewhere in a major city, because we've got, obviously, if you don't live in Australia, we've got 5 or so big population hubs where pretty much everyone has to live for work and that kind of thing. So how do young people, what are they doing to get into the market? It seems like it's a very challenging thing to do. And is it even possible for a lot of people? Or do you have to tell people that, look, unfortunately, this is not going to work? Or how do young people, how are they getting into the property market?
Great question. Yes, it's possible. Do I at times have to tell people not right now? Yes, but I don't send people away saying that this is never going to be possible. I will always send people away with a plan of, okay, this is where you're at. This is where you ideally want to be, and these are the things you need to do in order to move that dial. Because buying a house, if you really break it down, actually gets a little bit more simple.
Okay.
Right? We need a deposit. Okay. To get a deposit, we've got to save money. To save money, we've got to make money, and we've got to spend less than we earn. So like if we break all of that down, we've actually created some strategy sessions at Penny. So we actually bring first home buyers on the journey all the way from when we're creating their budgets with them and we're understanding what their income is, what they're spending, where they can maybe cut back, what their goals are, what their surplus is, how much can they actually save, and how long is that going to take to get to a point where they have a deposit. The government is making it easy in certain ways. You know, they've got government schemes and initiatives and stamp duty concessions to actually make it easier for first home buyers. To be honest, as someone who bought their first house over 10 years ago, I actually personally think the incentives now are better than they were then. Yeah.
Okay.
And the interest rates, my first interest rate was in the 7s.
Okay.
So again, like there's certain things we can't control, and you touched on that really, really well. So what's the point of being so concerned about it? You can't change it. You can't change interest rates. You're not going to be able to change inflation. You're not going to be able to change the property prices. But what can we control is what's going on in our own world. So we need to settle our expectations. We need to figure out what we can afford, and then we need to work towards that. So yes, if buying a house to live in is what you want to do, there are tons of incentives out there. If you're in Melbourne, spending less than $600,000, no stamp duty, none.
Right,
so that's like $25,000 saving straight away. Okay. Right. The next major one is the first home low deposit scheme. It's called something else now, first home guarantee, I think is what it's called now. Essentially, you only need a 5% deposit to get started. So for that same $600,000 property, we need like 30 grand. Okay, now it's starting to actually feel like this could be viable. Maybe not right now, but in 6, 12, 18, 2 years, whatever it might be. And let's actually put the money aside so that can actually be a viable option for you.
Yeah, okay. And for a lot of people out there, I'm sure this is probably a really stressful thing to go through. Do you have any tips for young people kind of trying to just break into the property market for the first time? Experts.
I don't know about you guys and what advice you're spitting out necessarily for the share market, but you can go it alone. You can.
Yeah.
And it's a lot. It's a lot to navigate, not only from the finance point of view and debt and mortgages but then you've got to deal with agents and you've got to understand markets and different types of property. Like there is a lot. So step one would be speaking to someone like me, because we would want to create this plan that we're talking about. We would want to understand what can you actually afford, because I think another big mistake people make is they go and they figure, okay, I want to have that house and I want to have this big mortgage, without really understanding how that will play out in their life and what they'll actually have to sacrifice on a daily basis. And I say this all the time. What is the point of having a mortgage if all you're doing is sitting home and eating noodles because you can't afford to do anything else? Like the novelty will wear off pretty damn quick, right? So let's actually work out what's possible. So that's a good place to start, right? Because then from there, you're narrowing down your budget, which narrows down some areas and types of properties. You might even want to put another person in your corner, which is called a buyer's advocate. So they're actually someone who can actually source and negotiate and deal with the agents on your behalf, so you actually don't have to deal with it. Good option.
So I'm kind of interested, maybe for someone that's looking at getting into the property market and buying for the first time, if we were talking about how a big problem is people are trying to bite off more than they can chew. If we're talking about something like $1 million property, what are some of the sums involved? Like what do people have to save up for a deposit with like these government schemes? Like how hard is it? And like how do the numbers of what you personally have to save up and what kind of income you have to make change if you're looking further out where maybe there's a home for 600,000 or 700,000?
Yeah, it changes a lot, right?
Okay.
And the other thing with these schemes and these initiatives is that there's eligibility criteria. So a big one of them is how much you're spending. So realistically, for the stamp duty concession I mentioned before, you can only spend up to $600,000 to have the stamp duty waived. Between $600 and $750-ish, I'm pretty sure it is. There's a concession, so there's a discount. But if you're spending over $750, there's no discount.
Right.
So you may as well just be anyone, because I don't know.
Pay full price.
Yeah, the government's saying, okay, well, you can afford to spend $1 million on a property, go for it. Good
yeah,
luck.
right. Yeah, it's like, okay,
No.
well, you're with the rest of them now.
Yeah,
Good
correct.
luck to you.
And
yeah.
it's a similar thing with the home guarantee scheme as well. So there's eligibility criteria. So if you're a single person, you can't be earning more than $125,000 a year to qualify. As a couple, it's not more than $200,000. So that then starts to bump out those people who are trying to spend $1 million plus, because chances are their income's higher than that. So again, that's where just sort of speaking to someone like me, going through your particular circumstance, your particular borrowing capacity, that's definitely step one, because you don't want to go and get your hopes set, right? You don't want to go and think, I'm going to go do this, and then you come to talk to me, and I got to bring you back to reality. Like, let's just start with reality.
I think one of the things I was first looking to get into the market quite a while ago, and I went to see a mortgage broker, and I'm kind of grateful because the first thing that the mortgage broker said to me is like, look, I can see that you're eager, but you need to do better in terms of you need to have more savings and you need to have a higher income. And I liked the fact that, although it was disappointing at the time, he was at least honest with me, being like, okay, realistically, if you want to do this, say you want to buy an apartment that's in Canberra, maybe $600,000, this is how much you need to have saved up, and you need to be bringing in this amount for your borrowing capacity to do this. And I actually really, really, it was great, because then I was like, okay, I went out and I said, I'll come back in a year, I'll put my head down and I'll get it done, and I'll hit the figures that he said that I needed to hit. And that was actually really helpful for me. So
Exactly.
I definitely agree with you. And even in all areas, like business, for example, is leaning on the experts when you really should lean on the experts. For example, like as a business owner, going and finding a really good accountant, or if you're doing something where you need contracts or something like that, leaning on a good lawyer. I always tell people, from my perspective, if you need help, get it. So it sounds like in the property space, definitely mortgage brokers are one of those professionals that help you. And that's what your business is what you do. From your perspective, what should people look at in a mortgage broker? What makes a mortgage broker a really good mortgage broker, and maybe what makes them not so good?
Yeah, cool. I mean, I could go on and on about this, but
Please
I won't.
do.
I'll keep it succinct. No, a really, really good mortgage broker is going to be qualified and they're going to be experienced, right? So a bit of an issue with the industry is that there's a pretty low barrier to entry.
Okay.
Right. Okay.
Super low barrier to entry.
Interesting.
Yeah. And so realistically, the first 2 years of anyone being a broker, they need to be mentored, which is completely fine. Think about it like a university degree, realistically. Okay. So a new broker to industry, I am all for. I'm actually, constantly speaking to new people who are coming into industry. It's awesome. Mm-hmm. But transferable skills is really important. What have they been doing previously is really important. And then being part of a bigger group that has experience. Super important. So check the quals, check the experience. Probably what I'd say first and foremost. Then look at reviews, right?
Okay. Yeah.
Google reviews. Look on Instagram. What are they doing? Do you actually trust them? Like, do you connect with them? Because there's so many different brokers out there. You also want to be connected with one who gets what you're trying to do. So first home buyers, there'd be brokers out there who wouldn't even be across the first home buying incentives.
Really? Okay.
Right. Totally, right? Because they would specialize in something totally different, right? Exactly. A commercial development, broker who only does that and has exclusively done that for the last 20 years probably actually couldn't care less.
Right.
No offense about first home buyers. I'm not kidding. So it's really important actually to connect with the right type of people. Communication is really important. Transparency you touched on. So like someone who's not just saying, yeah, I can do it. Yeah, you can get that, but not actually going through and doing any numbers, like not actually putting their, money where their mouth is, so to speak.
Right.
Talking a bit of rubbish, not getting back to you. Like look, I've seen it all. And I have clients come to me all the time being like, I was with so-and-so, but they just never got back to me. I was like, what do you mean?
Yeah.
Red flag.
Okay. Right.
And does using a mortgage broker make the buying process more expensive? I'm sure that's probably something a lot of people think about.
Yeah, no, I think that it is. Like, do you guys, you've said earlier, you wouldn't say that you're that across it. Do you think it costs money directly to the client to use a broker?
I used to. I used to think, when I was first thinking about getting into the market, I was like, okay, do I go and see a mortgage broker? They're a professional, so I would imagine that I would have to pay, as the same, I go to my accountant, I have to pay him. I go talk to a lawyer, I have to pay them. I thought, okay, if I'm going to go talk to a mortgage broker, I'm going to have to pay them. And it wasn't until I don't know, probably a couple of years ago when I was first looking at getting the apartment that I'm in now, where I realized that actually that's not how the system is structured. So can you maybe take us through how that system is structured? And obviously you still make money at the end of the day because it's a profession. where does that money come from? Because it doesn't necessarily come out of the client's pocket, does it?
No, that's exactly right. So look, again, lots of different types of finance. Yep. So the sort of the higher up, the more sophisticated commercial development sort of stuff, there are costs involved directly. Coming back to residential finance, first home buyers, first time investors, people looking to build a portfolio, generally speaking, there's actually not a cost directly from the client to a mortgage broker. We're paid from the bank and we're paid a percentage of the loan balance. So that's another thing to take care of when you're considering which mortgage brokers you want to work with. A red flag would be a broker who's trying to push you to borrow more money unnecessarily, right?
There's a conflict there.
Oh, yeah. Yeah, absolutely it is, because they're paid based on that balance, right? Yeah. We actually kind of do a bit of the opposite. We actually don't even start with the loan amount. We start with repayment and what you can afford, and then we figure out what that loan translates to. And a lot of the time we're trying to talk you down. Do we really need to spend that much? It's going to be pretty tight. Yeah. Those are the sorts of conversations we'd be having. So no, the banks pay us. Ultimately, more than 70% of home loans are written by a mortgage broker. So we're massive. We're huge. The industry's massive. And for the banks, we're huge, right? Because if we're not sending them clients, where are they coming from? Like so many branches have started shutting down these days. Obviously your majors, they're always going to have a presence directly. But a lot of the smaller guys completely rely solely on brokers to introduce the loans.
So is it almost a case of the banks are willing to accept a little bit of a hit, and that hit goes to the mortgage broker?
Correct.
In exchange for the flow of mortgages that come in?
Yeah, it's a margin. Yeah.
Right.
And it's a very small margin in the grand scheme of things of what they're making. Yeah. But yes, that's correct. So there's absolutely no additional cost. It's not like they add that margin into the rate and pass it on to the client. Absolutely not. And in most cases, we can actually get better deals with the banks than you would get going directly to them, because we can negotiate with them for you.
One other question I had, just going back to kind of helping people kind of pick which mortgage broker they might want to go with. Are there any particular red flags you would look out for? I mean, you kind of mentioned just then kind of not replying to emails and that sort of thing, but are there any other kind of red flags specifically that people could look out for?
I think if they're not asking you a lot of questions.
Okay.
So like I could very easily, and I've been doing this a long time, I could very easily get on a call with a client and I could put a deal together pretty quick. I could push it through the system. We could get it approved and it could all be done, right? We could do that. Like we shouldn't do that, but we could do that. So I think it's really important that they're asking you a lot of questions. They should be getting to know you so incredibly deeply in all of your dreams and aspirations and where you're trying to get to. I spend a lot of time asking my clients why. If they've come to me to buy a property to live in, hypothetically, right? I'll be wanting to understand that, like why in that particular area, why that sort of property, what their longer term goals are, what their next 5 years looks like. Because I might say to them, well, guys, if that's really where you're trying to get to, then this is not a great idea. Or, the opposite, who knows? So yeah, if they're not asking you a lot of questions, if they're not trying to really, really get to know you, that's a red flag to me, because to them, this is just a transaction. They just care about getting this loan and moving on to the next person. Far from ideal. So that's a big one. We can go on with that if you like, but it looks like you want to ask a question.
Oh no, I'm still steering down, like I'm looking at the structure, because my brain always thinks about compensation and how that leads to conflicts of interest. So my question is, you were saying that the banks kind of take a little hit, and that's how the mortgage broker makes the money in the transaction, in the arrangement. Do different is there a potential conflict of interest? Do banks offer a different rate for a mortgage? So is there a bank that will give you as a mortgage broker more for signing someone up to that particular product? Does that create a conflict of interest? Is that something to watch out for? Or is that's not true?
Great question. Used to be a thing. And then we had a little thing called the Royal Commission.
Okay. Right.
Yeah. So now everything is very standardized. Okay. So across the board, as a broker with a particular lender across the board, we're getting paid the same. Right. So like just because that guy writes more with that bank, he's not getting paid more. Whereas that definitely used to happen.
That's good. I'm glad that doesn't exist. Because I guess it's the same if you went to see a financial advisor and they say, oh yeah, you should do this because this company pays me more money. That's the only reason you should. Yeah. So no, that's really good. I'm glad to hear that.
Just on the pay stuff though, like there are brokers out there who are charging though, just to clarify, like we are a professional service. We are within our rights to charge. I have the strategy sessions that I mentioned earlier, depending on sort of where you're sitting in your home buying journey or your property portfolio building journey, we do have strategy sessions, and there is a cost associated with those and the time and the effort and the planning that goes into it. We don't charge our residential clients, but there are some brokers out there who might charge, to get your pre-approval, right? Because they might be concerned that you come to them for that pre-approval and then not buy, and then they've wasted their time. Because realistically, that's what happens, right?
Bit of give and take.
There's a lot of give and take, because this is the full 411. We don't get paid until a whole month after you settle.
Right. Wow.
Right?
Okay.
So if you're coming to me today and we're talking about the home buying journey, and I send you away for 6 months and go save your money, and then you come back, we do a pre-approval, and that lasts 3 months, and then you've got a 2-month or 3-month settlement term. It could be 12 months before I get paid any money.
There's a lot of upfront work.
Huge amount. All the work's done upfront.
Yeah.
And then even after you settle, we're still waiting another month.
Yeah. Wow.
Crazy.
A lot of lag time.
Do you have any? I was going to take the conversation towards building a property portfolio. Do you reckon that's something?
Yeah. Let's do that.
Because so that's, I think what we've spoken about so far is kind of like getting into the market. But once you're in the market, this is something that I kind of hear people say your second property is easier than your first. And especially, I don't know if that's true, but that's what I hear.
If you get the first one right.
Okay.
Yeah.
And obviously what we've seen in Australia with the performance of our property over many decades now is that it's been a really good place for investors. Investors have made a lot of money. So can you explain what the process is of people maybe getting into the property market and then saying, you know what, I've built up more savings, and you can maybe explain how the processes of using equity or refinancing or all that sort of stuff. How do investors in property actually do it, I guess?
All right. So yes, the first one is the hardest, because you've got to save the money, right? So if we go back to those couple of things that we realistically need to buy a property, we need the deposit, and then we need servicing capacity. So the deposit, we've got to save the first time around.
Okay.
But best case scenario, you get property one right, and it does what it's supposed to do, and it grows.
Yep.
Then where you start from and then where you end up in a couple of years' time, you've manufactured that equity, right? So either you've paid down some debt, or the property's grown, or a mixture of both, which then means that we can access that equity. So we can do a top-up loan, or we can do a refinance to access that equity. And then now we've got cash again that we can then put towards that next property that you haven't had to save for. Maybe you've also saved, right? So then maybe you've saved as well as you've had your property grow, which then might mean you get into the property number 2 faster. If, however, once you've bought property 1, you actually don't have too much savings capacity, that's where you then might be reliant purely on that capital growth and then getting access to that equity once it becomes available. But this is, again, where portfolio strategy planning comes into place.
Very individual, I imagine, for everybody.
Absolutely, right? Because if you've got a ton of surplus cash lying around, you got high income earners, they're not having to wait for their equity. They're saving, and they're going again, and they're going again, and they're going again. Whereas you've got on the lower side, or the average income, they don't have that capacity. Not once they bought their first house, which then that brings me to rent vesting. Okay. Which is a whole other strategy, which I think is becoming so much more popular in the last few years. Because if you think about buying a house to live in, right? You are solely responsible for paying that mortgage. Rain, hail, or shine.
Yep.
Yeah. Whereas if you are someone who maybe still has the ability to live at home, or maybe you're someone who's in a share house, or maybe you're someone that's living with a partner, and actually renting is, from a cost perspective, pretty cost effective. Then if you were to buy an investment property where someone else is paying the mortgage, your life doesn't change. Your money doesn't change. So then you've still got the capacity to save. So it's only if you're buying a property to live in for most people that it actually chews up their cash flow.
Right. Okay. And is buying a property to live in and buying a property purely from an investment perspective, is that process the same? Is the mindset the same?
No.
Or are they completely different?
Yeah, I'd say they're completely different, which again goes right back to my first conversation that I'm having with a client about why they want to buy property. Because if they're saying to me, like the person you mentioned earlier who just desperately just needs a house, they just want to live somewhere, they just want to feel safe and secure, and that's what they're craving, well, that's one thing. But if you've got someone who wants to buy property because they do actually want to get ahead, or they're trying to look at this from an investment perspective, it's a totally different property we're probably buying, right? Because client number 1, we've got to look at their borrowing capacity. We've got to look at where their family is, maybe where their work is, and we've got to buy purely based on those emotional, realistically,
and what they
parameters,
want.
what they want, right? Whereas if you open up the whole entire country for me as an investment option, well, we can literally look anywhere, right? Because we're sitting here in Melbourne, but there's a lot of reasons why you would or wouldn't invest in Melbourne right now versus why you might or may not invest in Queensland, or you may or may not invest in Perth. And there's different markets for different clients depending on different price points and so many other variables. So when you're buying for own occupied, it's very emotionally driven. When you're buying for investment, it should be very financially driven. It should be very data driven, market driven.
Right.
What makes sense?
Right. Okay.
What tips would you give to somebody that maybe they've bought their own place and they're sitting on a little bit of equity and they're saying, you know what, I would like to start investing and building a property portfolio. If someone like that came to you, what are some of the things that you really sit down with them and say, okay, this is what we need to consider? What would be your tips to someone that wants to take the leap and venture away from the home that they live in and start to accumulate more properties for investments?
So in this example, is this person happy with the property that they're in? They're planning on staying there, and this is purely from an investment perspective?
The way I'm seeing it is they're happy in their home. They've done that. They've gone through that property journey and they've ticked that one off. And now they're like, okay, maybe I've got a little bit of equity in my own home. Now I want to come to you because I want to potentially look at starting that snowball of my wealth through acquiring more properties. When someone comes to you, what are the tips that you should give them, or what are the what are the problems that people run into?
Well, this is the exact penny client, right? We help clients like this every single day, multiple times a day.
Okay.
So step one is don't sit on equity. Like if you've got equity in your property, you should be doing something with it, right? Absolutely, well and truly. That's step one. So to work that out, we order evaluation. We can do that for free. We understand what your property's worth, what your debt is, and what equity we can access. So from there, we can work out, okay, well, we've got a deposit of X. Is it 100 grand? Is it 50 grand? Is it 70 grand? Is it 200 grand? What does that look like? Because then from there, we can start to build out a property portfolio. We can start to work out, okay, realistically, why are we all doing this? You guys are share market guys, right? Why are we doing all this? Why does anyone invest?
To get more money back.
To be able to retire at some point, to be able to actually stop trading time for money and at some point have your investments take care of you. It's the same thing, right? We're all realistically pretty simple beings. We kind of want the same things. So what I do is I plan this out with them. We go forward and I say, okay, well, if we could realistically sit here 15, 20, 25 years, whatever that time frame is, how much money would you want? How much money do you think you're going to need? And then we work backwards from there. So we actually fully plan it out. Now, a big tip that we need to just, touch on here is that most people will go about this in the wrong way, and most people will get stuck on 1 to 2 properties. If you look at the stats around Australia about the number of properties that investors hold, it's low. And the reason for that is they hit a serviceability limit really quick.
Okay. Right.
Okay. Yeah. So your servicing capacity is all to do with income, right? It's to do with your income. It's to do with the rental income. So there has to be income in order to service debt, right?
Yep.
And you can't just keep taking on more and more and more and more and more debt. And so that's where structuring comes into place. So instead of buying investment properties in personal names, we help our clients structure them in entities like trusts, where we use accountants and financial advisors and lawyers and getting everyone together on the same page. So then we don't hit those same ceilings.
Right. Okay. I've not thought about that. How does that work? Or is this something where we're getting too into the weeds?
No. Look, we can stay high level with it. But ultimately, let's just say you've got property 1, right? And you're going to go to the bank and say, hey bank, or hey Morgan, how much extra money can I afford to buy property number 2? And we're gonna get a number around that, right? So shall we say it's $1 million?
Sure.
Hypothetically. But that's it, right? So then if you go buy $1 million property, that's it.
Yep.
You're done. You're tapped out. You could divide that up into 500,000 for argument's sake, but then you're done, right? So we're tapped out again. However, if we buy in an entity, okay, so we set up a trust, property holding trust, we buy property number 2 in that trust. We've got property number 1 already, remember?
Yep.
So we buy property number 2. Let's just say we've spent 500,000 on that property number 2. It's got its rental income. It's got its expenses. We've bought really, really, really well so that property's taking care of itself. When we go back to the bank or to Morgan for property number 3, we're going to have another look at our capacity. And what we're going to see is that we only have one property in our name. The other one sitting in a trust is taking care of itself. We get to completely ignore it.
Okay.
So then we get to go again.
So you go again.
And again.
Interesting.
And again.
Okay.
Is there any problems with that system?
It's more expensive.
Okay.
It's more sophisticated, obviously.
Right.
So if you're going to set up an entity, you got to think about yourself then becoming essentially a professional investor.
Yes.
Ultimately, right? So you're increasing your accounting costs and you've got to do a tax return every year. And yeah, there's plenty of things to consider. And of course, at that point in time, we have to get our clients to go get that accounting advice and get that legal advice so they are completely across it.
Yep.
Because I'm coming at it purely from a debt point of view. If you want to build a property portfolio, you cannot do it in your personal name unless you're making squillions of dollars.
Yep.
Squillions of dollars, right? Then sure. But is that average Australia? No.
Yeah, true.
And how much does kind of property cash flow come into this kind of equation? Because I'm sure, I think for most of Melbourne, if you're buying into a property for an investment, the rent is probably not going to be covering the mortgage expense. So how does that play a role? Do you look for specifically for, or do you encourage people to look for positive cash flow properties, or how does that all work?
It depends, is what I would say there. And this is again where it comes down to a portfolio, right? So, similar to shares where you talk about diversification, right? And something being up and something being down and something being sideways. Property is a little bit similar. So you're going to have properties in certain pockets of Australia that are going to cash flow really well, but may not have the same level of growth that, say, a particular Melbourne market might have. So when you actually build out the portfolio, sure, you might have one property that's running fairly neutral. Then you might have one that's potentially, running at a slight loss. So then the next one, we might be then looking for one that's cash flowing better again, which might help to balance out the portfolio. But again, it also comes down to the client, because if I've got a client who does have that surplus cash to cover that balance, then we're totally fine. But I'm not going to be able to put an investor who's a little bit more tight on cash into one that's, losing money, right? But then in saying that, I also don't like the thought of going and buying investment properties are just costing an exorbitant amount of money. It doesn't make any sense to me. I can't make that compute. So realistically, we want properties that are relatively neutral. That's what we're trying to go after.
Okay. Interesting. I think the last kind of question that I had was, I guess social media, it's a great place, but it can also be a little bit questionable. We see a lot of people, they turn one property and then 2 years later they've got 3 and then they've got 10 and then they've got 20 and then they own the whole world. And, sure, maybe some of them make millions and they can do that. But I always look at that kind of content and feel like, I'm a bit skeptical of that.
Skeptical, you should be.
Yeah. I'm wondering, like, what are for someone that wants to get on this pathway of building a property portfolio from an investing perspective, what are some of the things that you really need to watch out for? Where do people get themselves into a world of hurt? Because as we've seen from prior market conditions, property can be quite painful at times. So where do people make the mistakes when they're investing in property?
Awesome. So taking the wrong advice. So fair enough if you consume content online, that's great. I mean, we post a ton of content online. It's a way to attract people to our page. And then obviously we hope that they get on a call with us and then we talk to them about their particular circumstances, right? So I wouldn't be going and making any actual decisions based on stuff that you see online, getting the right people around you. So, I've talked about what we do at Penny, right? So if building a property portfolio is something that you want to do, a firm like ours is a good firm to be connected to, because not only are we finance brokers, but we have the accountants to connect you to. We have the solicitors to connect you to. We have the buyer's advocates around the country who do all the market research and know where to buy and what to buy in particular price ranges and what the markets are likely to do, right? Obviously, nothing's an exact science, right? No one has the crystal ball, but we can make some pretty good judgments. And I personally think you're much better off putting a team around you rather than going at it alone, unless you've gone through and done an exorbitant amount of research, right? If you do actually want to spend that time, great, but also just be careful of who you're listening to. Ultimately, with that. Next thing is the actual type of property, right? So you can get it wrong.
Right.
You can get it wrong.
Yeah.
I personally made mistakes, and I get to talk about them now as mistakes. But obviously, how do I wish I could go back? There's so many things that I would do differently if it was me. But a big one of those is buying off the plan. There's so many risks around buying off the plan.
Okay.
And we're seeing it a lot at the moment. And it's not only just off the plan, say apartments, but it's also house and land packages too. Because essentially what you're doing is you're committing to something well in advance of it being in reality, right?
Yes.
And so the major risk around that is that then it's not actually worth what you've paid for.
Right.
And that happens.
Because I think that's people get sold that a little bit as it's a more affordable way to get into the market, because
if all going perfectly.
Yeah. Well, that's typically, I think if you're buying off the plan for an apartment, it might seem on paper like it's cheaper than, say, an established apartment, because there is that, I guess there are some variables that the apartment still has to be built. So do you, I guess it's probably individual, but is that something that you typically steer clear of for people looking to get into the market?
Look, I've seen it go wrong way more times than I've seen it go right.
Okay.
Realistic. And what I'm talking about is the huge high rises.
Okay.
Right. The big apartments where there's like hundreds of them. Right. Because ultimately your apartment is only ever worth what next, the one next door is worth. And these big apartments are being built usually in areas where there's a lot of that going on. So there's a lot of new stock all the time. So then in terms of your apartment, like what are the chances of that growing anytime soon? Because someone can just go buy a new one. And they probably will do that, right? So density is huge. So buying an apartment is okay, but I would be, if that's your price range, I'd be trying to prioritize like a more boutique complex, with a lot less apartments in it. That's a little bit more unique. The other thing is to worry about with that is like the body corporate costs can be absolutely outrageous. And when you're being sold off the plan, the problem with that is you're kind of putting everything into the future and thinking, oh, like future Morgan will worry about that. Future Morgan will have better income and we'll be able to save better. Mate, if you're not doing it now, you won't be doing it then. Let's be real.
It's interesting because to get into the property market, the apartment that I live in, I bought it off the plan. So it's interesting, but I live in Canberra for those that don't know, and we have height limits. So all of our apartment buildings are quite small. There's not that many apartments in the complex. So I'm lucky that it worked out quite well. And it was always for me to live in. I was not thinking about it necessarily from an investment perspective at the time. But what was interesting is that to what you were saying, we have one main road that goes straight down the middle of the city, and it used to be all government housing. And they decided that all this government housing at the same time would demolish it. And so they replaced it with new developments. And that was a big problem for even the people that had bought for an investment perspective, is that all of these new apartment blocks were going up at the same time. So they all came to the market at the same time.
Correct.
So while everyone was buying into this nationwide thought that rents are just going through the roof, in this particular sub-property market in Canberra, actually people were really struggling to get tenants in, because they had all of a sudden at the same time, because they knocked down all the government housing at the same time and they built all these at the same time, they had all these apartments coming onto the market at the same time.
And then it becomes a price war.
It does.
And then you got to drop your price of your rental if you're an investor.
Yep.
And then that impacts your cash flow.
Exactly. So that was really interesting. It's just an interesting anecdote saying that is exactly what happened, what you were talking about.
The last thing that I see in terms of mistakes is, when we touched on it, is around the structuring. Okay. So if you've already gotten started and you've bought your first investment property, and maybe you're looking at buying your second investment property, and then you go and you do that, and then you come to me to buy property number 3, hypothetically, and then I look at your borrowing capacity and I know that we're tapped out, or maybe we might get one more and we might not be able to get another. Rewind all the way back to the very beginning, and getting that structure right from the very start is super important. Because if you get down the line, if you already own property 1 and property 2, you can't just change that and put it into an entity, right? Because that actually means selling it from yourself to your entity, which is going to involve stamp duty,
right?
And no one wants to do that, realistically. So getting this right from the start, creating a plan, executing the plan is what I would suggest.
So it sounds like definitely the number one tip that you would have is to get good advice. That sounds like it. So I guess
The resounding.
Yeah.
Point.
Hamish, is there anything else that you wanted to ask? Because I'm happy to leave it there if you want.
Yeah,
Awesome. And that leads me to talking about Penny. So if people are out there and they want to get in touch with you and your team to discuss property investment or, first home or whatever it might be, how do they do that?
We hang out mostly on Insta.
Right.
@_Penny Finance. We have recently done a rebrand, which if you haven't seen it, I would love you to check it out. I'm so proud.
Oh, okay.
When I started the business, I had nothing, less than nothing. So I did what I could at the time. But yeah, recently we did a massive relaunch, rebrand, and it's incredible. So we obviously had a really cool new website too, which is, as you would expect, pennyfinance.com.au.
Awesome. And people can just reach out to you on the website?
Yeah. So we have the first thing to do with us is just a discovery call. So it's allocated 15 minutes. It's going to be with a broker. It's free. So ultimately that's the first step to getting introduced to us. And we use that as an opportunity to get to know you, for you to get to know us, make sure it's a good fit. And
do people need to know a lot of information? Like,
No.
do they? No, not at that point yet.
Not at that point yet. No,
Okay.
this is just an intro call. From there, we're then going to suggest potentially which strategy session to put you into. So if you are the investor, we put you into a portfolio planning session. If you're a first home buyer, we might put you into a penny plan. Like, it's just going to depend on where you're at. So we'll use that call to determine that. And then from there, of course, we'll let you know what to prepare.
Awesome.
Great.
Well, Morgan, thank you very much for coming in today. Thanks for having a chat to us. As you can tell, we don't know very much about property. So it was
great fun.
it was really good to pick your brain on that. And I think a lot of people will get good value out of that. So yeah, thanks very much for joining us.
Yeah, thank you.
Thanks guys for tuning in, and we'll see you guys in the next one.
See you guys.
See ya.